What is the timeline of Islamic finance development? Imagine a financial system built on fairness, ethics, and shared prosperity. That's what Islamic finance aims for, and its journey spans many centuries. Let's walk through its key milestones together. It all started in the 7th century when Islam emerged. Early Muslims focused on ethical money management, avoiding interest and sharing risks. They used partnership contracts called mudaraba, bills of exchange, promissory notes, and trusts known as waqf. These tools supported trade across regions, using gold dinars as a common currency. Back then, formal banks did not exist, but merchant partnerships and informal credit systems thrived. Between the 8th and 12th centuries, Islamic financial ideas influenced the development of markets and economies. During this period, Islamic capitalism grew, with financial activities linked to trade and community welfare. Although no formal banking institutions existed, the principles of profit sharing and risk management were well understood and practiced. Moving into the 13th to the 19th centuries, Islamic financial practices persisted but remained mostly informal. Some organizational enterprises and agency institutions appeared, but full-fledged banks were rare. Interestingly, during this time, European economies adopted some Islamic financial ideas, especially in trade and credit systems. The early 20th century saw a shift. The first Muslim-owned banks appeared in the 1920s, marking a move toward formalized Islamic finance. However, these banks often operated within conventional banking frameworks, not fully aligned with Islamic law. The real turning point came in the 1970s. In 1975, Dubai Islamic Bank was established as the first fully Shariah-compliant bank. That same year, the Islamic Development Bank was founded as the first international Islamic financial institution. These events marked the beginning of modern Islamic finance. Countries like Pakistan, Iran, Sudan, Malaysia, and Bahrain started developing Islamic banking on a larger scale during the 1980s. Conventional banks also began offering Islamic products through dedicated units. The 1990s and early 2000s saw rapid growth. Islamic banks and financial institutions multiplied worldwide. New products like Sukuk, Islamic bonds, Islamic mutual funds, and Takaful, or Islamic insurance, were introduced. Countries such as Malaysia, Bahrain, Saudi Arabia, and the United Arab Emirates became key centers for Islamic finance. Today, Islamic finance continues to expand globally. It serves millions beyond Muslim-majority nations. Governments and regulators have created standards to ensure Sharia compliance and stability. The industry faces challenges like standardization and innovation but remains rooted in core principles. These include prohibition of interest, avoidance of excessive uncertainty, ethical investing, asset-backed financing, and profit-loss sharing. From humble beginnings rooted in ethical principles to a thriving global industry, Islamic finance's timeline reflects a steady evolution. Its history shows how tradition and modern finance can come together to serve communities and promote shared prosperity.